I want to start off today's video by apologizing for yesterday. I was connected to a speaker. It didn't catch any of the audio, but not too big of an issue. The message is going to remain largely the same and largely similar to what we discussed on Friday when we highlighted that in the past our account had been locked out and we handled that situation, ended up being okay in terms of returns because of it. We're doing something similar here. We're expecting something in the longer term period, and we're expecting something in the shorter term period. We don't expect the shorter term thing to be such a big deal, longer term, but we don't want to be just a sitting duck, so we're going to hedge for it. We're going to prepare, and we're going to make some plays that will be sold once this situation plays out. And that situation is the yields that we're currently seeing right now. The 10-year being below 3%. Now, yesterday when we recorded that video, Friday when we recorded that video, we were more off 3%. We got at below 2.8% on the US 10-year. Now we're well back up above 2.9, if I remember correctly, which I believe I do. That is a significant move, and we're probably going to continue that until the next Fed meeting. So another 2 weeks of rates rising, and the market's had some strength here. It's gotten some strength. I'm not really selling anything. I just trimmed a little bit. I'm not buying any more TBT calls. I did that yesterday and late last week. So now I'm just going to sit pretty and wait for rates to get back up above 3%. Because as we have said in the past, and as obviously the Fed has said, they're raising rates above 3%. Like they're getting there, and then they're going to evaluate if they need to do more. So for the 10-year to be at 2.7, it's a little ridiculous. For you to, I guess, buy it at 2.7, you have to assume that it's going to go even lower. So I think we're getting a reversal of that, and we saw, roughly 10 plus basis point move today. So we should expect, or can expect, I think, a little bit more. And once we get back above that 3%, if we get to 3.1, 3.2, people are going to freak out. They're going to say, oh, whoa, the Fed's going to tighten. They're really going to clamp this thing down. You heard people today talk about how inflation isn't going to come down, how it's going to be very sticky. I'm not in that camp anymore that I think inflation is going to be incredibly sticky unless oil comes back dramatically, which I don't think will be the case unless the administration does something stupid. And I saw them do something questionable today with Iranian oil, but I don't think it's going to be too big of an impact. I expect Iran to continue to sell to China. So we'll have to see what happens, but I think if oil prices can stay around 100 and not continue to rise, we can see some leveling off of inflation. And we don't need to get much above 3.5% on the US 10-year. So I expect rates to chop around 3 to 3.5%. But for this last move into that range, to spook people that thought we were in the all clear. I know this because I've been in that position in the past throughout my life. And I think there's a lot of people who are doing that, think we're in the all clear, and they're going to get hit by algos when the rates go up. So let's just see what happens with that, and we'll go from there. So I intend to, at some point, once we get to around 3.5% in my TBT calls, to sell those, sell my SPY puts, sell my hedges, and take that hedged cash and put it to work in other positions. So we're prepared. We like our stuff. We're playing this as if our account was locked. We're ready for, to weather some storm, but we're also hedging the downside. So that's today's video. And until next time, peace out.